BlackRock just told you the truth, and I need you to understand how extraordinary that is, because the largest asset manager on earth, a firm overseeing more than $10 trillion, does not speak this clearly unless there is something major happening beneath the surface. This is not just another market comment. This is not routine Wall Street noise. This is one of the most powerful financial institutions in history, openly signaling that the case for gold and silver is getting stronger, not weaker. And right now, telling the truth about precious metals may also happen to make them a fortune, because institutions do not position themselves after the move. They position before the move. Then they let the rest of the market catch up. That is why what BlackRock's iShares investment strategy team for the Americas recently published may be one of the most important institutional analyses on precious metals in years. And almost nobody in the mainstream financial media is giving it the attention it deserves. Why? Because the implications are massive. What BlackRock is saying cuts directly against the story Wall Street has been feeding average investors for years. Because if regular investors truly understood what BlackRock has now admitted publicly, there would be a rush into gold and silver that would make every rally we have seen so far look small by comparison. So let me walk you through what they said. And I want to be careful here because I do not want anyone saying this is exaggerated or taken out of context. This is BlackRock's language, framework, data, and conclusion. And when you see the full picture, you are going to understand why the precious metals bull market is not fading out. It may be entering an entirely new phase, a phase driven by forces that barely mattered 5 years ago. But before we go deeper, drop a comment and tell me where you are watching from tonight. I always ask this because the precious metal story is not local. It is global. Are you watching from the United States, Canada, the UK, India, Pakistan, the Middle East, Africa, Europe, Australia? Let me know your city or your country. Every time I ask that question, I am reminded how global this audience has become. And that matters, because the story we are talking about tonight is not just an American story. It is not only a Western story. It is the story of a world slowly waking up to the reality that fiat currency, meaning money backed only by government trust, is under pressure, and that hard assets are once again becoming critical. Now let's start with the numbers, because the numbers are what make BlackRock's analysis so explosive. Gold surged roughly 75% over the past year. It broke through $5,000 per ounce for the first time in January. Silver exploded 148% in 2025, then added another 19% in January alone, even after a brutal 26% decline on January 30th. Read that again. Silver gained 148% in a single year. That is not a modest rally. That is not a slow climb. That is not a normal move. That is a market erupting. That is what it looks like when a metal that has been undervalued, ignored, and in many investors' view, suppressed for years, finally begins to reprice in response to a much bigger monetary reality. And here is the part that should get everyone's attention. After a 75% move in gold and a 148% move in silver, BlackRock is not telling investors to take profits. They are not saying the move is too far, too fast. They are not warning that this is a bubble. Instead, they are saying, in plain language, that we may still be in the early stages of a new wave of demand coming from fresh sources such as central banks, cryptocurrencies, and the AI build-out. The early stages. Think about that. Gold above 5,000. Silver more than doubled. And the biggest asset manager in the world is still saying this may only be the beginning. Now let me break down the 3 major catalysts BlackRock identified, because each one of them alone could support a multi-year precious metals bull market. But all 3 happening at the same time, that is what creates the possibility of a demand supercycle. And that is what the supply side may not be able to handle. The first catalyst is sovereign debt. This is the one many of you already understand if you have followed this channel for a while, but hearing it from BlackRock carries different weight. These are not the comments of a YouTube creator or an independent newsletter writer. This is one of the most powerful institutions in global finance, saying government debt levels have become deeply concerning. According to BlackRock's framework, debt levels across major economies have climbed to dangerous territory. In the United States, federal debt now exceeds 120% of GDP. That means for every $1 of economic output the country produces in a year, the government owes more than $1.20 in debt. And the problem is not static. It is getting worse. Annual fiscal deficits are still running around 6 to 7% of GDP. In simple English, the government is spending far more than it brings in year after year. And this is not just an American problem. Blackrock also points to debt burdens across major developed economies, including Japan, the United Kingdom, France, and Canada, where debt loads have risen beyond levels that used to be considered normal. So ask yourself the obvious question: how do governments solve this? Realistically, they have only a few options. They can raise taxes sharply, which risks crushing growth. They can slash spending, which risks political upheaval. Or they can keep borrowing and relying on central banks and the financial system to absorb the pressure. And what has the world chosen so far? More borrowing, more debt, more currency creation, more promises. And that is exactly why gold and silver matter. Because they are monetary assets that cannot be printed. They cannot be created with a keystroke. They cannot be inflated away by desperate policymakers trying to buy time. The second catalyst Blackrock identified is one of the most fascinating developments in the entire story, because it represents a brand new category of demand: crypto and stablecoins. BlackRock points to stablecoins and the broader digital asset ecosystem as a growing source of potential gold demand. And the numbers here are remarkable. Tether, the world's largest stablecoin issuer, has reportedly accumulated roughly 140 tons of gold. Pause on that for a second. A digital money company now holds more gold than the official reserves of most countries. That is not a minor detail. That is a sign of how fast the financial landscape is changing. A company that did not even exist 15 years ago now holds a gold position that puts it on the level of major sovereign holders. And this may be only the beginning. The stablecoin market has grown from around $28 billion in 2020 to more than $280 billion in 2025. That is a tenfold increase in just 5 years, and future projections go even higher, with some estimates reaching $1.9 trillion by 2030 in a base case, and as much as $4 trillion in a more aggressive scenario. Now think about what that could mean for gold. If even a portion of stablecoin issuers decide to diversify reserves away from pure dollar exposure and into gold, the impact on physical demand could be massive. BlackRock highlights two possible channels. The first is that issuers like Tether may choose to hold more gold alongside treasuries and Bitcoin as part of their reserve mix. The second is that investors may begin moving toward tokenized gold or gold-backed digital products as an alternative to dollar-based stablecoins. Either path matters. And if both paths grow at the same time, then gold demand could be hit by a source of buying the physical market has never had to absorb on this scale before. That is why BlackRock says we may still be in the early stages, because this is not the same gold market we had in the 1970s. It is not the same setup we had in 2011. This is a market being pushed by sovereign debt pressure, reserve diversification, crypto reserve accumulation, and industrial technology demand all at once. These are structural drivers. That means they are built into the system. They are not temporary. They are not likely to disappear because of one Fed meeting, one inflation print, or one jobs report. They are bigger than that. By the way, how are you watching this? Are you on your phone, desktop, or TV? Let me know in the comments, because I am working on better chart formats for future videos, and I want to make sure they look clean on whatever screen you use most. Now let's get to the third catalyst, because this is the one tied directly to silver. And it is the one that connects to the Shanghai price divergence, vault drain, and industrial demand story we have been covering. BlackRock confirms that about 60% of annual silver consumption is tied to industrial uses. That includes electronics, solar panels, semiconductors, and AI infrastructure. Electronics alone account for roughly 445 million ounces of annual silver demand, making it the single biggest industrial use category. And that demand is not slowing, it is accelerating. Solar photovoltaic technology, in simple terms the panels used to convert sunlight into electricity, accounted for nearly 29% of total silver industrial demand in 2024. Back in 2014, that share was just 11%. That is nearly a tripling in 1 decade. And every major energy outlook suggests solar capacity will keep expanding through 2030 and beyond. Then there is AI. Global data center computing capacity has grown from around 1 gigawatt in 2000 to nearly 50 gigawatts today. That is a huge expansion, and all of it depends on silver-intensive hardware. Server connections, circuit boards, switches, electrical contacts, relays, cooling systems, power systems. Silver matters because it is the best electrical conductor of any element on the periodic table. There is no true replacement that performs just as well at scale. So when you build a solar farm, you need silver. When you build a data center, you need silver. When you build electric vehicles and advanced electronics, you need silver. And when all of those sectors expand at the same time, at the fastest pace in history, demand begins to run into a very hard limit: mine supply. This is the supply-demand imbalance that keeps draining physical inventories. This is why vault levels matter. This is why regional price differences matter. This is why a physical premium in Asia matters, because industrial users do not care what the paper market says the price should be. They care about getting the metal. They care about keeping factories running, panels shipping, and AI infrastructure online. If that means paying a premium over a quoted Western futures price, they will pay it, because not having the metal can be more expensive than paying up for it. Now let's talk about central banks, because this may be the most important part of Blackrock's analysis for the long-term direction of gold. Central banks hold around 20% of all mined gold on Earth, and between 2022 and 2025, they steadily increased reserves as part of a deliberate move to diversify away from the US dollar. Then came a historic shift. Last year, gold overtook US Treasuries as the largest share of global reserves for the first time in 30 years. That is a huge statement. For decades, US Treasuries were the foundation of the global reserve system. Central banks held them because the dollar was the dominant reserve currency, and Treasuries were seen as the safest large-scale reserve asset in the world. But now, the world's monetary authorities have been showing through their actions that gold is regaining priority. That is not a vote of confidence in the old system. That is a signal that confidence is changing. In effect, central banks are saying that a hard asset with no counterparty risk is becoming more attractive than a government promise backed by rising debt. And they are not slowing down. Blackrock cites a 2025 survey showing that 95% of central banks expect global gold reserves to rise in 2026. That is up from 81% in 2024 and 52% in 2021. So the trend is not weakening, it is strengthening. More central banks are joining the buying wave, and the countries that started early do not appear ready to stop. Now here is the part many people miss. Some of the largest economies still have surprisingly low gold allocations. Countries such as China and Brazil reportedly hold less than 10% of reserves in gold. Compare that with Germany, where gold is above 70% of reserves, or the United States, where it is above 75%. That means some of the world's biggest economies still have plenty of room to buy more, and every additional percentage point of reserve allocation represents major new demand hitting an already tight market. Let me give you another part of Blackrock's analysis that deserves a lot more attention. Private wealth allocations to gold are still around 50% below levels seen a decade ago. That means average private investors today are far less exposed to gold than they were 10 years ago, even though the reasons to own gold have arguably become much stronger. Debt is worse, currency debasement risk is higher, geopolitical instability is higher. Yet, Western private portfolios remain underweight. BlackRock notes that gold ETPs make up only about 0.17% of U.S. private financial assets and remain below their earlier peaks. That tells you something very important. The average Western retail investor is not fully in this trade, not even close. And when that changes, the next demand wave could be enormous, because once financial advisors, wealth managers, and mainstream portfolio allocators stop ignoring a major move in gold and silver, fresh money can enter very quickly. And that is exactly why this bull market may still have room to run. I hear this all the time from people who have been stacking physical metal for years. They say, nobody around me is buying gold or silver. Their friends think they are extreme. Their advisors dismiss precious metals. Their families roll their eyes. And my response is always the same. That is bullish. Because market tops do not happen when almost nobody around you cares. Market tops happen when everybody cares. When your barber starts giving you silver targets. When your rideshare driver starts talking about gold allocations. When the average person who ignored the sector for years suddenly wants in. That is when you should worry about a top. We are not there. BlackRock's own data says private allocations are still far below historical norms. That means the Western household has not fully arrived yet. And when it does, the impact could be dramatic. If this breakdown is valuable to you, like the video because it will help more people find this video while the topic is still early. Subscribe to Bridgeport Finance and turn on notifications because the pace of change in the precious metals market is increasing and timing matters. Now, let's connect BlackRock's macro view with the silver chart, because this is where institutional analysis meets technical setup. On one side, we have the fundamental case. BlackRock says precious metals demand is being driven by structural forces. Central banks are buying. Debt is rising. Stablecoins may become a new source of gold demand. Silver is being pulled higher by solar, AI, electronics, and electrification. Private investors are still underallocated, and the dollar-based system is under strain from rising debt and deficits. That is the macro picture. On the other side, we have a silver market that has been consolidating in a 3.5-month triangle formation, tightening more and more as pressure builds. Independent analyst Rashad Hajiev of RM Capital Analytics has identified that pattern and projected an initial breakout target near $130, with a secondary target around $153. And according to that framework, 153 may not even be the final high. The expectation is for a later parabolic phase that could carry silver into a much higher range, potentially $240 to $260. Now, I know some people hear numbers like 153, 240, or 260 and immediately dismiss them. I understand that reaction. If you still think of silver as a $25 or $30 metal that only spikes in a crisis, those targets sound extreme. But let's remember something. A year ago, gold near $3,000 sounded aggressive to many mainstream analysts. Now it is above $5,000. A year ago, silver in the high 80s would have sounded absurd to most people. Now it is already traded there in the West and even higher in Shanghai. The numbers that sound crazy before a major repricing often look obvious after it happens. And that is why physical market signals matter so much. The Shanghai premium is one of the strongest indications that these higher targets are not just fantasy. When Chinese buyers pay well above Western paper prices, that is a sign of tight physical supply and stronger real-world demand. And every day a large price gap remains in place, there is an incentive for metal to move toward the higher-paying market. That draws down inventories elsewhere. That increases strain on the Western pricing system. That makes paper leverage more fragile, and that increases the risk of a sharper repricing event. BlackRock itself acknowledged silver's move has reflected strong investor demand, strong industrial demand, and a less liquid market. That phrase matters. A less liquid market. Because when liquidity thins out, price can move violently. It does not need to rise in a slow, orderly line. It can gap higher. It can jump. It can suddenly reprice in a way that leaves people behind. And that brings us to volatility, another point in the report that many people will misunderstand. BlackRock notes that year-to-date volatility in gold and silver has jumped sharply, with silver's volatility more than doubling. Some people hear that and think it is bearish, but BlackRock's interpretation is not that the move is broken. Their message is that the rally is powerful, though not without risk. Powerful, that is the word, and that matters. Because volatility is not the opposite of a bull market. Very often, volatility is the signature of a bull market in its acceleration phase. Look back at gold in the 1970s. It was extremely volatile on the way higher. Look at silver in 2010 and 2011, also highly volatile. Why? Because when a market is repricing after years of distortion, the process is rarely smooth. The old price is no longer credible. The new price has not been fully discovered, so the market swings hard while it searches for a new level. That may be exactly what precious metals are doing now. The old prices were based on a different world, a world of stronger confidence in fiat currencies, a world of lower debt pressure, a world with less visible stress in reserve systems, a world with less industrial demand pressure on silver. That world is changing, and the new prices that reflect the current reality may be much higher than what many people still consider normal. Let me ask you something directly. Has your financial advisor ever told you any of this? Has any mainstream financial professional in your life ever sat you down and said, BlackRock believes we may be in the early stages of a precious metals supercycle driven by central banks, stablecoins, sovereign debt, and AI infrastructure? Has your bank ever explained that private gold allocations are still well below historical norms? Has your brokerage ever told you that gold has recently outperformed bonds during major stock declines? For most people, the answer is no, and there is a reason. The advisory industry is built around products that generate recurring fees. Mutual funds, managed accounts, portfolio products, fund structures. That is the core business. Physical gold and silver do not fit neatly into that model, so precious metals get ignored, minimized, or dismissed as old-fashioned, speculative, or unproductive. Meanwhile, BlackRock, the same giant institution whose products sit all over the modern investment system, is publishing research that says the precious metals bull market may be far from over. That disconnect is revealing, and that is one reason this channel exists: to take institutional research, market data, and exchange signals and translate them into plain English that regular investors can actually use. Now let's talk about gold's role in a portfolio, because this is where even skeptical investors should start paying attention. BlackRock studied every month since 2020 in which the S&P 500 fell more than 5%. In those months, gold delivered an average return of about positive 2%, while the US aggregate bond index was much closer to flat. That is very important. Because when stocks were falling hard, gold was not just preserving capital, it was often rising. And bonds, the traditional defensive asset that many advisors rely on for diversification, were not providing the same support. This is what BlackRock describes as asymmetric diversification. In simple terms, that means an asset that can help protect a portfolio when other major assets are under pressure. And in the current environment, BlackRock's own data suggests gold is doing that job better than bonds in many stress periods. That should matter to anyone still relying on a classic 60-40 portfolio and assuming bonds will automatically provide safety in the next downturn. Silver plays a different role. BlackRock says silver has not always provided the same downside protection. That makes sense. Silver is both a monetary metal and an industrial metal. It benefits from currency weakness and hard asset demand, just like gold. But it also benefits when industries like solar, electronics, AI, and electrification expand. That is why silver can outperform gold in the right environment. And that is exactly what we have seen. Gold gained around 75%. Silver gained 148%. That is silver's higher beta in action. In simple terms, silver tends to move more aggressively than gold. So if BlackRock is right that this is still early, and if gold has meaningful upside left, then silver could have much larger percentage upside. And that aligns with the more aggressive technical projections now circulating in the market. Everything is converging. BlackRock's macro research, central bank buying, private investor under allocation, stablecoin reserve diversification, Shanghai strength, dollar strain, debt stress. These are not isolated signals anymore. They are lining up, and that is what makes this moment so important. What I find most astonishing is that this conversation is happening here, in a long-form video, while much of the mainstream financial media is still focused on short-term noise, quarterly earnings headlines, and overvalued growth stocks trading at extreme multiples. N is gold, but it offers greater upside potential during periods of reflation, industrial growth, and economic expansion. That makes sense. The biggest monetary shifts of the modern era may be unfolding in plain sight, and the public is barely being told. The data is not hidden. The research is not secret. The signals are public. BlackRock's work is public. Exchange data is public. The issue is not access. The issue is interpretation. No waiting, no delay, no next week recap, and in a fast market, time matters. The difference between learning about a move at midnight and hearing about it the next afternoon can be the difference between entering at one level and chasing much higher. When Blackrock releases something important, I break it down quickly. When physical premiums move, I post it. When inventory changes matter, I post it. Make sure you follow and turn on notifications. Because institutions move in real time. And if you want to understand what they are seeing, you need real-time visibility too. Let me be very clear. This is not just speculation. This is not simply a gamble on headlines. This is Blackrock, the most powerful asset manager in the world, saying in plain language that the forces pushing gold and silver higher appear structural, long-term, and possibly still early. And when Blackrock speaks that clearly, you should pay attention, because Blackrock does not publish research out of kindness. It publishes research to prepare, position, and inform capital. So if they are telling the market that precious metals may have much further to run, it is because they see a setup worth taking seriously. Silver near 89 while Shanghai prints triple digits. Gold above 5,000 while central banks hold more gold in reserves than treasuries for the first time in 3 decades. Private allocations still far below historical norms. Stablecoin-linked gold demand potentially scaling from almost nothing to something huge. AI, solar, and industrial electrification consuming silver at a pace mine supply may struggle to match. A powerful chart setup tightening. And the largest asset manager on earth saying we may still be in the early stages. So subscribe to Bridgeport Finance right now to get all the update you for the market move. And share this video with people you know who have money in the financial system but still do not understand what may be developing in gold and silver. Because if this move turns truly parabolic, and it may, the informed will be positioned before the crowd. And those who ignore it will be forced to react later at much higher prices. I know which side I want to be on. When the world's largest asset manager tells you the precious metals bull market may be far from over, you do not dismiss it lightly, you position carefully, and hold on,